Hey everyone, it's Imran from Options Insight, your macro options spotlight.
Remember, like, subscribe, comment, ask questions, do whatever you like, but we want to get the algorithm passing this around so people can learn about options and learn this information.
Okay, stocks once again pulled back from intraday highs to finish unchanged ahead of Powell speaking later today, actually at 9 a.m. Eastern. Confirmation of a Chinese stimulus and a commitment to support growth from policymakers there is helping to drive European stocks. So European stocks continuing to outperform another 1.25% in Euro stocks and DAX. And we also managed to trigger a copper breakout. So you saw copper up 3% on the day. That's a 1.5 sigma move, so pretty healthy move. And along with that, we're finally starting to see a bid come back to copper volatility, back at 30 and a bit vol, up around 75 basis points on the day. So a decent move up in copper vol. Copper vol's been languishing for a while because it's been quite range bound. Finally breaking out, starting to see that catch a bid. What else is going on? If we look at the dollar, so seeing a good move in euro as well, back through the highs, touching local highs actually yesterday of 107.60, a little bit shy of that right now, but a 1.3 sigma move up there when the vol is 9.5. You know, an 80-bit rally is quite a strong rally. So euro catching a bid there. Yen kind of stabilizing, still stuck at 132, but really it's the dollar, it's the CNH that's moving the most. Another 1.7 vol adjusted move there as the yuan continues to strengthen. And then lastly, the thing that stands out is ARK having a decent bounce, 1.3 sigma move, up 4.5% on the day. That's 5% on the week now. We had flagged in one of our daily notes last week that we thought selling put spreads on ARK kind of made sense here, as these tech names were pretty beaten up and in need of a bounce. I do think the crypto stocks really bouncing quite hard yesterday is helping. You had some of the likes of Riot and Mara up over 20%, Coinbase up a good 15% as well. So those sort of stocks do sit in the ARK basket, or some of them do, like Coinbase. So that really helping ARK bounce. But we do think there's scope for ARK to continue to bounce through earnings season if some of these names don't have disastrous numbers and show that there's a chance of getting back to profitability, basically. All right, so that's it for the summary. Moving on. So looser financial conditions. So what am I talking about here? So Jay Powell obviously due to speak at 9 a.m. Eastern. And judging by what US financial conditions have been doing, and this is according to JP Morgan, this is the blue line here, we're kind of back to Jackson Hole levels, right? So when Powell initially came out very, very hawkish at Jackson Hole and the market reacted, financial conditions arguably through a number of measures and metrics that JP look at are back to those levels. So that's not a great result when you've hiked rates the amount that they have, and you're looking at financial conditions and potentially saying that they're kind of back to those levels. So I don't know if Powell's going to say a lot today, but at the margin, he's probably not going to say anything dovish if he's looking at this chart, right? So we think he probably cares about these financial conditions, but he might not want to admit it too much. So don't expect a dovish message, even though the market's probably not going to believe any hawkish rhetoric that comes out of Powell. We do think at least the shock higher on a dovish message is probably not in play for today. So just something to be aware of there. Later in the week, obviously, we mentioned yesterday we've got CPI. That may still provide some upside on continuation of this disinflation theme, especially if the core services ex shelter comes down. That's the key metric to look at. And even Daly, I think, said yesterday that's what he cares about. He or she, I think it's a she, right? The skew in the US volatility surface suggests that investors still need upside protection. So that's the chart here on the right. So we saw on an up day, the vol was quite well bid on the upside call. So this is the 1 day percentage return versus the NASDAQ. This is the QZTF 1 month 25 delta call implied vol change. So basically, if that number's high, it means people are bidding up for upside calls. And if that number's high when the market is up, that's relatively unusual, because you can see from the regression fit, when the market's normally up, the vols go down, which is why we're under the zero line down here. And when the markets go down, the vols typically go up based on that regression. But here you had a bit of an outlier in the market being up a couple of percent in NASDAQ and the vol being up nearly 2 vols on those 25 delta calls. So that's a spot up, vol up dynamic that we don't typically see. And we only really see it when people are kind of scrambling to get upside exposure. So we do think that investors are still positioned bearishly. We do think that this theme for skew being low is going to persist for a while because investors just don't need put options, right? In a portfolio that is underweight and priced and ready for a recession to take markets lower, what you need is upside vol, not downside vol. If you want asymmetry in the book and you want premium to protect you, you're not looking to the downside, you're looking to the upside. And, we don't think that until investors get more bullish, and that might be driven by China's stimulus narrative, people piling a bit back into the market on some sort of 1 or 2 month reflation type move. Until that happens and people get less bearish and are actually positioned for equities higher, we don't think skew and downside is going to perform. So we've got to watch out for that, and I don't really think we're there yet. Okay, next thing I want to talk about is gold. So we're going to do a bit of a deep dive on gold in today's call. So gold is at resistance levels now around that between 1870 and 1900 is pretty much a big resistance on a number of counts. So we said late last year the gold positioning had some room to get longer. We thought the violent move in silver may attract people into precious metals, and gold was somewhat lagging, so we thought it had upside. We were looking for ETF holdings to increase. We've started to see that. We had 2 consecutive weeks of ETF holdings going up. Inflows there. Central banks, obviously, that's been in the press. They've been buying like crazy. Fast rate of buying from central banks, particularly China, who have bought about 62 tons in the last 2 months, apparently. And then finally, CTAs are also getting forced in as well, because obviously they're price chasers, they're momentum chasers. And so the Z score on positioning for gold futures is near the top of the range if we look back at the last sort of year. So all those things showing that positioning has definitely been addressed and is starting to get a bit long, or we're starting to see a lot of buying. Now, the dollar obviously still on the back foot. Gold has decoupled from real yields. We see this big gap between gold and real yields inverted here. So gold to me is looking pretty stretched in the short term. High RSI readings, a slightly bearish momentum divergence. All these things are pointing to a bit of a pullback or a breather required in gold rather than just the continuation of this move. We like taking that contrarian view because it does seem like every man and their dog is bullish gold right now. So when it's this far to one side of the boat, let me take a leaf out of Jared Dillion's book. I know he's a gold perma bull, but even he would probably admit that everyone's a bit too bullish on gold right now, I suspect. Okay, if we then move to what else I'm seeing kind of back up my thesis here, gold options are not really buying this rally. So, changes in fixed strike volatility are our favorite way to track what option dealers are thinking about a certain move in an asset and if they're having to chase the price action. So this is the monitor that I created, about a month ago. This is one of our new sort of parts of our service. And this fixed strike volatility map is showing me that in February, March, and June expiries, as we've moved from 170 to 174 in gold over the last 10 days, it's about a 2.6% rally. What has happened to the implied volatility across all the different strikes? You can see all the strikes above the current market, so the upside strikes, are all in the red. So that means they're all down in volatility terms. You can see that here on this 3D chart as well. You can also see that here on this, but this is just for the front month. So you can see as we've rallied, if people were chasing this thing on the options side, you'd expect call options to catch a bid. But if anything, call options are getting offered. They're getting sold in volatility terms. So the market is not thinking that, some massive breakout is happening in gold. They started to get a bit of a bid for the calls before the rally happened. But now that the rally is actually materializing, we're not seeing a continued bid for those call options. So that suggests that option dealers at least are thinking that this move is getting a bit tired as well. And they're certainly not feeling the pressure to go and chase it, which means they probably own volatility or certainly upside volatility. And therefore that will mute the moves as well if we were to break higher. So that's kind of what I'm seeing in terms of what the option market's telling me anyway, in terms of gold. So how would I play it? Well, I'd look to my trusty Vol dashboard and I would say, well, what are the strategy compass saying? That's saying bearish risk reversals. That involves buying puts and selling calls. Why is it doing that? Because spot is overbought, vol is kind of neutral. So generally spot overbought, vol mid-range, we're looking at things like bearish risk reversals. Now, the only thing with a bearish risk reversal though, is you have to be comfortable to be selling those call options if you're going to do a bearish risk reversal. And from my perspective, gold does look overbought, but it's at a very key level. If we look back on the chart, back to middle of last year, if it breaks that 1900 level, then the kind of highs are basically the next target. So I don't really want to be short call options in a market that is testing a big resistance. And if it takes it out, all hell could break loose. So I'm not selling those calls. So for me, a bearish risk reversal is not the safe play. So if I want to fade this move, I think it's overbought, I think it's going down, I'm going to move to the buy put spread camp, where I don't want to buy too much vol. I don't want to pay too much time decay while I'm waiting for the move down, because this thing is not really realizing as much as it should. The vol carries positive. That tells me that it's not realizing. The Vega's mid-range, that tells me I don't want to just buy outright options. So I land on buying put spreads as my solution there. Okay, if we go to which put spreads I'm buying for the trade idea. All right, that's it for today. It was a deep dive in gold. I think that's quite a topical one right now. So see what you make of that. And please give me feedback. Let me know if you like these ideas. And let me know if you disagree, right? At the end of the day, I don't claim to be right all the time. So thanks for listening.